yesterday the inflation figures came out for New Zealand. Not with the hiss of an aurora, I have to say, but I would have thought quite good news. Inflation for New Zealand dropped to, I think it was 4.7% in the 12 months to the December 2023 quarter. But whether or not that is as a result of Reserve Bank policy, of international trading relations and what it actually still means, or whether or not it's due to a fall-off of GDP activity. So it has a sort of a twisted edge to it. We'll find out in a minute. Also, the Reserve Bank of New Zealand has imposed some new lending regulations, or I'm not sure if they're new or they've certainly revised them. But in that release that they point to two trading banks who with mortgages, we are joined to talk about the general economy and recent economic indicators with leading Auckland businessman and economic commentator Craig Stobo, and he joins us now. Craig, lovely to have you on.
Good morning. How are you, Michael?
Well, listen, first of all, that inflation rate of 4.7%, I think it's good news because it's going down. Am I right or am I wrong?
Well, it's definitely gone down for the annual number. That's correct, going from above 5% to 4.7%, and it's slightly better than what the Reserve Bank was expecting. But as always, you have to look a little bit more at the detail behind that number. And there are always two components that we look at. One is the tradables component, so that's what's going on with imported inflation. And secondly is what we call non-tradables, so call it domestic or service sector inflation. Now, while the tradables annual number dropped to 3%, the actual non-tradables number was higher than expectations at 5.9%. And that's the sticky bit that I mentioned, I think, at the last interview I did with you last week, is that service sector inflation is incredibly sticky and hard to bring down.
Yeah.
That's things like rates and insurance, etc., as examples of non-tradables. And the Reserve Bank will be sitting saying, well, we've had some wins on the tradable side, but that's volatile. Witness the increased transport costs now for shipping that won't go through the Red Sea. It'll come down underneath South Africa, increasing container costs and freight rates. So tradables can be volatile. The difficult one for the Reserve Bank is non-tradables and that service sector inflation, which will have added impetus by firms that are putting wages up for their workers, for example. So, I still stick to my view that there's not enough in there for the Reserve Bank to do anything just yet. The economy is certainly cool, but it's not in recessionary conditions. Adversely worsening recessionary conditions, and so I think, given the single mandate the Reserve Bank has now, solely focused on inflation, I think they'll stand by and keep watching the data.
So
the OCR,
this is unlikely.
5.5.
They're unlikely to relax the OCR, or is it stay where you think? Yeah.
Correct.
Okay.
Still stay at 5.5. Because remember, the target's 2%, and we're sitting at 4.7 overall for annual price increases. We're still well away from that midpoint of at 2%, and we have sticky services or non-tradables inflation. So if there's any sense that the economy is picking up, and there's some indications that business confidence has improved in the December quarter, for example, if that's the case, that won't be helping restrain prices. So I think the Reserve Bank will sit on the sidelines.
All right. The other thing I've noticed also, when you're talking about tradable and non-tradable inflation, obviously a component of that is rent. Now, rents are obviously still going up. Is that simply due to the lack of housing supply?
Yes, and population's been added to by migrants, as we've spoken about before.
Yes,
they don't necessarily have track records with banks, with credit scores, etc. And if they don't have access to cash that they bring with them or with their relatives, for example, they would normally be candidates for rent. for rentable stock. So we're not building enough fast enough to cope with that, and so there's definitely upward pressure on rents, and that part of that non-tradable component.
Yeah. Craig, the other thing that I've talked about and leading into your introduction was this Reserve Bank New Zealand indication, well, sort of a direction, I think, to banks in terms of lending criteria and the kind of loans that they can have and what percentage of their portfolio they're allowed. Can you explain that to me, why they've brought that in, number one, and number two, what effect it'll have upon the housing market, if any?
Yeah, so they've used traditionally loan-to-value ratios, so that goes to the percentage of a house purchase, for example, which can be lent, and they have various components to that, so it's 75% or 80%. But that goes towards assessing a loan against an asset, so that if the asset price falls, the borrower still has some equity in the house to enable them to, for example, in the worst case scenario, to be able to repay that loan. But what, of course, it doesn't do is, from a Reserve Bank prudential management perspective, is assess the affordability or the serviceability of those loans. So you may well have a low loan-to-value ratio, let's just pick a number, 60%, but the interest costs of that in recent years have gone up substantially to the point where some borrowers are paying a very large amount of their take-home pay out in servicing debt. And so the Reserve Bank's brought in this metric, debt to income, to try and encourage banks to think more carefully around affordability issues, not just the size of the mortgage, but the ability to service it. And that's where they're going in a prudential sense.
So the aim is to make sure that if there is a reverse in the housing market, banks aren't as exposed as they were, say, during the American crisis of, 10, 15 years ago?
The DFC, yeah. Well, look, my view is banks are already looking at your budget, they're looking at your outgoings, they're looking at your credit scores. So in some senses, this increased supervision is formalising what I believe the banks are doing already. But it does mean that there's a benchmark or a marker now that banks will have to report on back to the central bank.
Craig, you're a bit younger than I am, but so I'm struggling to remember. But then I wasn't probably into house buying as quickly as you were, because you were always able to earn more money than I was because you did the right degree at university. But can I say, I'm struggling to remember a time in New Zealand's economic history, and I studied a little bit of economic history, in which you needed 7 times your salary, or you had a bank that was prepared to lend you 7 times your salary to get, or gross salary, to get a mortgage. And that mortgage still couldn't buy you a house in most parts of New Zealand. Can you remember a time when it's ever been so bad in terms of how much debt you have to get into a house?
Well, you're the historian. You're absolutely right. Our debt-to-income ratios, or household debt-to-income ratios, have been at the top end of OECD and other country rankings. I mean, Hong Kong, at one point, ourselves, we were above 10 times. So to buy a house, you needed 10 times the average household income in New Zealand, which is off the charts and goes to questions around sustainability of incurring debt with that salary line. So you're right. In historical terms, it's unusually high and still is.
Okay, and is it going to change? Because surely we must get to the point, and you're the expert, I'm not, but surely we've got to get to the point where the amount of debt you take on is so great in terms of purchasing the New Zealand house that you can't have children. You've got to have both people working, yourself and your partner. You can't do anything because you are paying off this horrendous mortgage. Have I got that wrong?
No, you're the household ownership stats continue to indicate falls in ownership, and that's partially driven by that issue around debt and needs to be incurred. Very quickly, that loan, which may be serviced when you're by two incomes, when your interest costs are 2-3% per annum quite easily. You change that interest rate outlook and you're paying mortgage rates of 7.5%, as some people are facing as they come off very low fixed rate mortgages into a different environment, and suddenly your bandwidth to service that debt changes because you can't employ any more principals in the household, both, for example, or in the case of single-parent households, one is already working full-time. You can't do more overtime. You might better work weekends, and you then say to yourself, well, I just can't afford this. And you have to think about selling the asset. So one of the precursors to falls in house prices is serviceability of the income. And if you lose your job with rising unemployment, that's when the pressure comes on. So at the moment, that pressure is building, in my view, as the economy remains cool and unemployment starts to rise. That does mean that more and more mortgage holders will come under pressure around serviceability.